Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me, as usual, is Jonathan Charlo. He is also a partner and our lead analyst. As with prior webinars, today's session will last 45 to 60 minutes. If you have any problems with the audio of the webinar, we would encourage you to turn off any other applications that may be running on your computer. We will also post a copy of today's webinar and materials to the SilverOak website. It should be posted within, I would say, 3 to 5 business days. And if you want to listen to any of our past webinars, they are out on the website as well. If you have questions regarding any of the materials we discussed today, please feel free to contact your SilverOak advisor after today's webinar. If you're not currently working with a SilverOak advisor, you can feel free to contact me directly at 952-896-5701. And I want to thank Jonathan, you and the rest of the team for putting all of the material today together and getting it ready for our discussion. I know it's a big task to do in a very short time, so appreciate everything that you do, and for Dan and the rest of the team that deal with the technical components of this. During today's webinar, we will not be discussing specific SilverOak portfolio performance, since each of our clients' portfolios are customized. However, all of our clients should have received their quarterly performance reports, and if we haven't reached out to you to discuss those, I'm sure we will be here in the next couple of weeks or over the next month or two. And lastly, since I am the compliance officer, I need to make note that during today's discussion, we will be going through the overall markets and economy, and in doing so, providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions, and of course, past performance is no guarantee of future success. So with all of that house cleaning out of the way, let's talk about the agenda. As we typically do, we'll spend the first 15 to 20 minutes talking about the economic data for the quarter. Then we'll transition into a discussion around market data, and I guess most interesting, talk about SilverOak's outlook going forward, not just looking backwards. Today's special topic at the end of the webinar will be on cybersecurity, a big issue these days with the recent data hacking of Equifax and the breach that occurred there. So we'll talk about how to try and prevent those types of events from occurring and you being personally impacted. We'll give a couple of updates on SilverOak items that are happening and a few reminders for everybody to consider as the year comes to a close. And of course, we encourage questions. As I mentioned, after today's webinar, if you have questions that you'd like to have addressed, talk to your SilverOak advisor. And prior to the next webinar, if you have questions, certainly reach out and provide those to us. I think for today, Jonathan, we had one question or comment that came in that we will be addressing a little bit later in the webinar.
Okay.
So with that, Jonathan, where are we from an economic standpoint?
Again, solid growth during the third quarter. As we've said for many quarters, the growth has been steady, hasn't been extremely high, but in this case, this quarter, the most recent GDP growth data came in a little bit stronger than expectations.
So we'll talk about the GDP and some of these other components as we go through the economic data, but what we're showing here, kind of to get the conversation started, is our market dashboard. We introduced the dashboard probably last year sometime. I can't remember if it was the third quarter or fourth quarter, but we introduced the dashboard during one of our webinars, and we went through the details. At a high level, we break the dashboard into 4 components: the economy, the credit markets, valuations, and market sentiment. And those then combine to get to the composite score. And what you're seeing here is kind of a heat map where if the box is colored green, at least I'm colorblind, so I think that's correct, right? Green is good.
Green is good.
Green is good, so that's positive. If it's kind of a grayish, that's more neutral, and red is bad. So as we look through this, we're seeing here for the third quarter of 2017, and really for all of 2017, everything positive with the exception of valuations.
Absolutely. And so if you actually look a little bit to the left, you'll see that that was actually a little bit different in early 2016. The dashboard did actually show the weakness that we saw at that time. We've seen a strengthening. Everything looks good except for valuation, but valuation does not drive the market. You can be in a higher valuation situation if the economy and the markets are doing well.
Sure. And I should also point out, we have fourth quarter listed on this page, but this is a projected fourth quarter. Obviously, it's not actual since we haven't completed the quarter yet. If we look at the market dashboard composite, we're mapping it out here going all the way back to 1990. And the key when looking at this is not necessarily trying to interpret the small adjustments up or down, but maybe stepping back and looking at it from a bigger picture. And what I mean by that is that this dashboard's not trying to predict a pullback in the market, or for that matter, a big run up in the markets. It's just trying to give us some kind of indication as to how strong all of these components are together. And there does seem to be a correlation in market performance in the dashboard once the composite falls below 3.25. And you can see the scoring on the far right of this chart. So here, obviously, we're well above the 3.25 threshold in the composite. And therefore, at least, again, looking at the composite, that's giving us a more favorable sentiment of current circumstances. Is that fair?
Absolutely. Now, again, as you mentioned, we are projecting the fourth quarter, and so you will see the orange line and the kind of grayish-greenish line are coming down. Again, we're just straight lining the most recent quarter into the next quarter, and so at that growth rate, it means that it's slowing a little bit. Now, we don't know whether that will be the case, but that is just the little two lines coming down at the end.
Right, but still well above kind of that 3.25. And again, this isn't trying to predict what's happening in the market, certainly not over the next month or 2 months or 3 months, but it is giving us kind of support for the belief that things look good.
Mm-hmm. Now here we have kind of a scorecard of different economic indicators that we've really tracked for the last 3 to 4 years. On the left column we have the positive contributors, and what I'll say, kind of big picture, we didn't have anything move between neutral to positive or from neutral to negative. But what we did see is some nuanced differences going on. And so under the positive column, we have seen actually an acceleration in consumer confidence, hence we do have a positive arrow. On the corporate side, strong earnings, hence the positive arrow. Now, we did put a negative arrow under employment, but I will caution you when we get to that area that was likely heavily influenced by the hurricane. But employment numbers were weak in the last month. Within the neutral column, we've actually seen global growth pick up this year and this quarter, hence the positive arrow. We have a positive arrow for the U.S. dollar. Now, the U.S. dollar relative to a basket of international currencies is actually down a little bit, but that's very positive for U.S. companies, hence the positive arrow. Geopolitics, we did put a negative arrow because obviously there is a lot going on. And while the markets are doing well, volatility is low, there is always that wild card risk.
Sure. And I just want to make a couple of points, because we looked at the dashboard earlier, just a few minutes ago, and now we're looking at this kind of big picture economic factor chart, and everything looks good. I would say neutral to strong. There are a couple things longer term that could be weighing on the markets, and as an example, disposable personal income. It was up 2.7% over the past year. But when you compare that to consumer spending that's up 3.9%, that kind of indicates that consumers are borrowing more to justify the current level of spending that's occurring. And what that then leads to is lower savings rates. And we've seen that as a drop in some of the savings numbers that are published. That isn't good. As a matter of fact, without the savings reductions over the last 2 years, real consumer spending would have been half of what it was. So that really is indicating that we are starting to build up some debt, and borrowing is starting to weigh potentially on the consumer. And the reason that makes a difference is low savings rates do tend to correlate with low economic growth to follow. So we have to be a little bit cautious of that. The other thing that we want to be cautious of is productivity growth. It's very low too. Actually, in the past 8 years, it's been the lowest of any 8-year period since the end of World War II. So with this and other factors driving down kind of long-term inflation pressures, combined with the Federal Reserve embarking on their quantitative tightening and increasing of short-term rates, we could see the yield curve start to flatten in 2018, and potentially later in the year even invert. That would not be a good sign for the markets. So there are things out there outside of even shocks to the system that Jonathan just mentioned with North Korea and all of this that could weigh on the markets. But right now, based on the economic factors in our market dashboard, we just don't see any flashing red lights.
And interestingly, you mentioned the inverted yield curve, and that's actually something that we do track in the market dashboard in our credit market area.
Good point.
So that's something that we are watching. So GDP growth rate did accelerate in the second quarter, up to 3.1%. That's a higher number than we've seen in a bit, and there's been a lot of talk about whether we can permanently get that to 3% with lower regulation, tax cuts, and so forth. We'll have to see, because as you mentioned, productivity growth is a factor. Now, the first estimate for third quarter GDP will be coming out in the next week. That likely will be a bit lower than Q2 because of the hurricane. But the thought process is then in the fourth quarter and early next year, when we do see rebuilding, we'll kind of see that accelerate again. Manufacturing activity just continues to rise. So we're now at a PMI number above 60. And we have not been there for a while. We did briefly touch that in 2010. So that part of the economy is doing well. We're going to want to watch that because it's probably not going to be able to go much higher from here. Again, leading economic indicators have continued to trend upward this year. Now, the September PMI did come in with a decrease, a slight decrease, but again, we're kind of within that overall upward trend rate. We did see 6 of the 10 indicators positive, but again, we're at a high level, so we're going to want to watch that as well. We talked about consumer confidence and consumer spending. So consumer spending did come up in the last month and has kind of stayed at an elevated basis. And we've talked about in the past that after the election there was a dichotomy between Democrats and Republicans. What we've actually seen is that's moderated, and that's not a factor in the numbers. And
so you mean the confidence of say somebody that was more Democrat leaning versus Republican leaning probably wasn't as strong as the Republican was right after the election.
And so what we've seen since then is Democratic confidence has come up, Republican overconfidence has come down.
Yep.
And so the University of Michigan, in fact, didn't even really write about it in the September release. Now, earnings have been very, very good. And that's one of the reasons, or one of the likely causes of the market strength this year. But again, the outlook is very, very good for the next 4 quarters. So good, in fact, that as we get into next year, there will be a point where the kind of accelerated growth in earnings will slow.
Mm-hmm.
Here we kind of hinted at that, but we did see a decline of 33,000 jobs in September. Unemployment, though, did fall to 4.2%. Now, the U.S. Bureau of Labor Statistics did mention that there wasn't kind of a implication from the hurricane. While not all of the first hurricane impacted the third quarter, there was a decrease in fast food and they call it drinking places, in terms of jobs. And so there's clearly was an impact in the September number, third quarter number, from the jobs situation. So we'll want to watch the next couple of months just to make sure that there aren't other factors involved.
And of all the data that we've discussed here over the last couple slides, of course the employment numbers came down, but mostly driven off of the hurricanes, or at least that's the belief. The small business confidence, this is one that I guess of all of them is kind of moderated more so than really accelerated.
There definitely has been optimism among small business owners after the election. We did kind of see that really pop at the end of last year, and it's been in kind of a steady decline. Now, it was down this last month, but the prior month it was up. But when within the survey data from the NFIB, they did cite that the business owners are looking for some sort of tax package. And so I think that was where the optimism was, and we'll have to see. Now, there's a lot of moving parts, but bottom line, small business owners are still hoping for a corporate tax cut.
Well, and small business owners probably want individual income tax cut too.
And the pass-through.
Yep. So that summarizes the economic data, which I would say at a high level is, again, neutral to positive. Few cautions out there, but nothing blinking red. Mostly pretty good signs, at least more immediate, with some longer-term concerns. How did the markets do for the third quarter?
Market strength within the equity side of the markets was very strong, and it was widespread.
And we'll see that right here. So this is showing the U.S. equity markets with the top 3 numbers, and then the 3 numbers at the bottom of the page, or excuse me, 6 numbers, but 3 for each time period. Those are the international markets. So for the year, U.S. markets up anywhere from 10.9% to 14.2%. For the year, international markets up anywhere from 21.1 to 27.8. So, I mean, these are absolutely stellar numbers, whether we're talking about 10% or 27%. These are very, very strong numbers. Obviously favoring international, which we'll talk about in a few minutes. When we transition from the equity markets over to some other components like fixed income, you'll see actually relatively good numbers. I mean, we don't expect fixed income to ever provide 10 or 15 or 20% returns. I would say year to date that 3% is probably better than a lot of people expected, since we are in a slowly rising interest rate environment. So 3% is pretty solid. Of course, international bonds up considerably more, so that was something that we saw in the equity markets, where international equity markets outperformed. That has been true for international bond markets as well. The only negative here is pretty obvious with commodities. They are down for the year, up for the quarter, but still down for the year. And then we have long short up about 7% for the year, and REITs, real estate investment trusts, coming in up about 2.5%. Since the quarter end, I'm just going to mention, since the quarter ended, the Dow is now above 23,000 for the first time in history. I think it happened last Wednesday maybe. And of course, since then it's just continued to kind of continue above that 23,000 mark. This is now the third longest bull market in history. And what's different though this time, or at least seems to be a little different, is that broad global market participation. It's not just the Dow. Markets like the Nikkei are also at multi-year highs. So it's not just U.S., it's much broader than what we've seen in the last couple recoveries. With that, we'll break down the data between value and growth. So this chart is showing you third quarter and year-to-date information. At the left of each box is the value-oriented positions. At the right of each box is the growth-oriented. And you'll see for the quarter and for the year, growth dominated. And you'll see that right there in those circles. Growth is up considerably more than value. For the year, you'll see that large cap has really outperformed small cap, but that's not the case for the third quarter. So there was a little bit of a comeback in small cap for the third quarter. And really what was driving that recovery of small cap?
That is something we've seen in the last month, and that really occurred after the outline for the tax cuts came out.
So optimism that there's going to be a tax bill passed that's going to favor smaller cap over larger cap, so we're seeing that recovery.
Yep, absolutely. Good. Now here we'll talk about why growth has been leading the way. So in the top half, you're looking at those sectors that are have bigger weightings or are more associated with value. So you're looking at the third quarter numbers. And then here you're seeing the year-to-date numbers. So what I'll point out, if you look at the bottom, you'll see that technology has been leading the way in the quarter and the year. That's a very big weighting on the growth side of the market. And then you'll see healthcare year-to-date has also had very, very strong performance. Those two sectors alone are really driving that growth outperformance. If you look at value, you'll actually see that there are some sectors like materials, telecom that did pretty well in the third quarter. It's just that they have a very, very low weighting. And then you look at other sectors that even were down in the third quarter, or sectors that are down year to date. All of those together have really created a headwind for value at this time. And we have mentioned that international returns are really strong and leading the way this year. Here on the quarter side, you'll see it's widespread. Now this quarter we saw actually a little bit higher returns on the left side, so kind of more the emerging market. Last quarter we actually saw it a little bit more on the right side, which is the developed markets. But when you look at it on a year basis, yeah, the left side's a little bit higher than the right, but very, very strong returns from France, Germany, and Spain. Mm-hmm. So Europe is doing very, very well, and now emerging markets are doing very well. Now, bond returns, again, have been a bit more muted. Now, we are in the phase where the Fed is slowly raising interest rates, and so you'll see on the far right side, the Treasury bonds had the lowest returns. They're the most affected by interest rates, whereas if you look on the left side, those are more of the credit or risk-oriented bonds like the emerging markets. those have actually done well on a quarter basis and then on a year-to-date basis. The one you'll kind of see closer to the right that's up a lot on a year-to-date basis would be municipals. Now, they did overreact to the election last year, and so they've had a nice recovery this year, hence the stronger returns.
So, in summary, we have neutral to positive economic data that led during the quarter to very positive equity market performance, with international doing especially well in the 20+% range, with U.S. up 10 to 15%. We had growth significantly outperforming value that pretty much continued throughout the year and certainly in the quarter as well. And then we have bond returns that, although are positive, have been slightly impacted by a slowly rising interest rate environment. And we'll talk here in the SilverOak Outlook about whether we believe bond exposure should continue to be maintained or lightened up or maybe added to. So this is what we're going to get to in SilverOak's Outlook. First, with the economy in the U.S. Growth continues.
Yeah, and again, we mentioned that the Q2 number at 3% was a bit higher. We could see some higher numbers over the next year, but we don't think that that's what we're going to see over the next 5 years. We've talked about just the corporate earning rebound, and it just continues. The next 4 quarters are very high expectations, and we've seen double-digit gains this year. But again, next year, at some point, we will see those start to slow.
And that could impact the markets. If we're not, I mean, obviously earnings are the driver of valuation, so if we don't see earnings come in at expectations, even if they're strong, but they're not as strong as we expect, that could be a catalyst for a pullback.
And then on top of that, from the dashboard, we know that valuation is on the higher end. So
good point.
Right now, earnings seems to be driving the market, but if that slows, then you're in a higher valuation in the market, and so then you're in an environment where returns will probably, could be positive, but much more muted returns.
Sure. And of course, we have the Federal Reserve with its unwinding the quantitative easing kind of process, which gets us to something that we haven't even mentioned, but probably is quite impactful to the markets as we look into 2018, and that is who's going to be the chairperson of the Federal Reserve. Janet Yellen, the current chairperson, her tenure ends in February. Obviously, it's a position appointed by the president that goes through Congress and the approval process. Right now, I think there's probably maybe 4 leading candidates. Obviously, Janet Yellen's one of those. John Taylor, who's economist at Stanford. The Fed Governor, Jerome Powell, is, I think, the one favored by Treasury Secretary Mnuchin, if I'm correct. Then there's the former Fed Governor, Kevin Warsh, and also one of the president's economic advisors, Gary Cohn. So those are the 4 that are probably considered anyway to be the leading candidates. I would make note that 2 of those 4, John Taylor and Kevin Warsh, are considered critics of the Federal Reserve. So I think there could be some uncertainty if they come in and want to change things up real dramatically. So I think the markets are going to be looking at any sign as to which of these 4 or anybody else that will eventually be appointed.
Let's look now at the international economy. So we are seeing global expansion with low inflation. We're now seeing that in the U.S., we're seeing it in Asia, we're seeing it in Europe. And that also, I think, has driven the market. So that's something we'll want to watch going forward. The U.S. isn't the only national bank that is looking to become less accommodative. So the European Central Bank is kind of embarking on that, a few years behind the U.S. But we could be in a stage in the future where they're less accommodative. And then finally, we're seeing, again, strong and improving earnings from international companies. And that's something we haven't seen for a few years. And so that really is at the beginning of that cycle. And so again, Europe is probably a couple years behind the U.S. from
Sure.
a trend standpoint.
And this really gets, I'm probably going to mention this a little too early, but I'm going to throw it out anyway. It wasn't that long ago, maybe 12, 18 months ago, that we were hearing comments from clients saying, well, why do I even have international investments? You know, they had underperformed U.S. for, what, 3 or 4 consecutive years. And this is the very reason that we have international, is because they do rotate back into favor. They had been beat up. We don't have that big recovery that we've seen, and I think we have a chart toward the end of the webinar talking about the difference in the recovery that we've seen in the U.S. versus the international markets, and it's a very big contrast. So again, just favoring everything that you said, these improving earnings and all of this really does lean us toward more of the international exposure.
So we believe that there is potential upside on the U.S. Side of the equity markets, but it's going to be dependent on meeting those higher earnings expectations, seeing further growth. But I do think that the markets do have some sort of expectation of a lowering of the corporate tax rate, so we'll want to watch that. International
Treasury Secretary Mnuchin would agree with you.
Yes,
because he commented last week that if they don't get a tax bill,
right,
he thinks there's going to be a pullback.
Right. Yes. So we have another expert who is calling for a pullback. And again, we mentioned this, but international companies are going to fuel stronger earnings, so likely stronger international returns, certainly on a relative basis. But one of the things, you know, we've seen this year is that volatility has remained really at almost record lows. Now, we don't think that that's going to last forever. So, you know, that is something we'll want to watch going forward.
So positioning, we've kind of touched on this, but maintaining that diversified mix across the equities, i.e. getting that international exposure. Clients that maintained that, and I think pretty much all of our clients did, we're happy to do so because we've seen this year, obviously, performance twice as high as in the U.S. markets. Real assets, we do think they're attractive to potentially protect against some surprise inflation data.
And you typically see rising inflation near the end of an economic cycle, and you had mentioned that the Dow, third longest.
Yes.
Now, we've also seen that on the economy. So right now, this economic recovery is the third longest. And so if we're going to see rising inflation, we should start to see that over the next couple of years.
And real assets help protect from that rising inflation. We're actually making some adjustments. We added a real asset position, and we're making a few adjustments in our portfolios. Small adjustments right now, but adjustments positioning for what could be these higher inflation components.
Yep, absolutely.
Now, one comment, Jonathan, that we got prior to our webinar today that I mentioned or alluded to anyway early on was around this market correction and kind of the perceived imminent pullback that's going to occur. And don't get me wrong, at some point there will be a market pullback. That's just part of the market cycle. It will happen. The question is when, and frankly nobody really knows for sure. But the comment went on to say, with this pullback, what is SilverOak doing to advise their clients in adjusting their portfolios? And the way I would really want to address this is to start at the very beginning on how we develop our portfolio strategy from the very beginning, and that is around each particular client's risk profile and their objectives. And I would ask, and we have been asking our clients to go back and think about what their risk profile looks like. I've had a number of clients in the last year update their risk tolerance questionnaires to really assess, is their current strategy consistent and aligned with what they believe their risk profile to be. And of course, we have each of our clients go through this process, but sometimes a few years pass, things change, and maybe their profile has changed and we need to adjust accordingly. So it really starts with, what is your risk profile? And all of our clients have an investment policy statement. And in the investment policy statement, it outlines expected one-year highs and expected one-year lows. And if in any given year your investment policy statement says that you'd be willing to suffer a 15 or 20% loss, and you're not really willing to suffer a 15 to 20% loss, then we need to adjust that risk profile. And of course, Jonathan, that means not as much exposure to the downside, but also not as much exposure to the
upside.
That's right. And trying to time these things is impossible. So it'd be great if we could get out of the market right at the high and buy in right at the low. But even Warren Buffett will tell you that is just not feasible, certainly not consistently over time. The other thing that I would say to this question is, once we're consistent between our profile and the strategy, and clients are comfortable with that volatility either on a 1-year or 5-year basis, then what we do is we rebalance the portfolio. And what have we been doing, Jonathan, over the last year or two? We've been selling.
We've been selling stocks,
yes,
as they go up.
Exactly. Selling everything that's high, and we've been buying
things that aren't up as much.
That's
in this
right.
case, so bonds. But interestingly, 2 years ago, all we were selling were U.S. equities.
Yes, and buying international.
Right. And then this year, we've been trimming international.
Yes. So, this is an approach. It sounds very simplistic, but it is a time-tested approach. It's buying low, it's selling high, it's keeping risk profiles in line, and really current economic conditions, although they influence our global macro kind of outlook, we're not making day-to-day decisions on selling or buying, or even month-to-month decisions on selling or buying, because any of these so-called strategists or strategies to predict markets, they work until they don't work. And when they don't work, they can be very painful. So anyway, anything to add to that, Jonathan?
Well, I mean, we'll get to this when we talk about bonds, but of course, let's get back to this. Our dashboard doesn't really point to any sort of recession. We're not seeing that. We do know that bear markets are more associated with recessions. So when we say pullback, we're not necessarily meaning bear market at this point, but we are likely overdue for some sort of pullback.
Well, that's a good point.
We have not had a 10% pullback since last early in 2016. We haven't had a 5% pullback, and quite frankly, if we go another month or so, it will be an all-time record. And one of the things that I cited to you, which was in the Wall Street Journal, just pointing out that years that end in 7 are not good for the markets in the fall.
That's true.
And so here we are, kind of approaching the end of October, and when you look at the last 13 occurrences of a year that end in 7, you've had a 10% pullback between September through the end of November. We're not saying that's going to happen this time. We don't know. But if there was ever a time for a pullback from a seasonality standpoint, we're still within those months.
Good point. Yeah. I mean, if you look back, 1987, obviously crazy bad pullback. 97, 2007, and now we're 2017. Kind of eerie to think about.
Right. Now here, you kind of hinted at it, but there is a big performance gap between international investments in the S&P 500. So if you look in the middle of this graph, going back to 2011, performance was very close at that point. And then we did see the S&P take off. In 2012 and 13, the international markets were up, not as much. But then you'll see for a 2-year period, the international markets were actually flat to down a little bit while the S&P was up. And so while we've had very strong performance from international this year, we wanted to show you that this is likely a multi-year cycle. We don't know that international will outperform next year, but they do have some catch-up potential. And again, if the international company growth of earnings is at a higher rate than the U.S., that would be likely what the driver of that performance.
So let's talk about the fixed income markets.
So the Fed is likely going to raise rates in December, and we also know that they're likely going to raise in 2018, and kind of the expectation is 3 times. And they did begin unwinding quantitative easing in September. So going forward, they're not going to repurchase bonds that mature, so taking some liquidity out of the markets. But we do believe that bond yields are likely going to remain in a trading range because we don't expect the Fed to raise rates substantially. They're probably only quarter-point increases. And we have seen the 10-year Treasury a little bit volatile this year. In March, right after the meeting, it hit almost 2.7%. And then in early September, when there were kind of fears of the hurricanes and economic growth, we almost hit 2%. And so we do think that that range really still is 2% on the low end, 3% on the higher end over the next couple of quarters. And again, volatility is going to likely continue because you still have economic data that is kind of moving around still, and then there's still the kind of Fed issue, and there's other issues like the tax cuts and other things. So that's likely going to play into it. But from a positioning standpoint, this gets back to why do we own bonds in the portfolio? Now, some of it is yield, but part of it also is that it's the ballast in the portfolio. And so I know we've talked to fixed income managers who basically talk about the high valuations in bonds. And so from that standpoint, we're not in the part of the cycle where you want to stretch to take on riskier bonds to get that higher yield. And so at this point, I think investors in a diversified portfolio should be happy with the yield that they're getting, but probably not capital gains from the bond portion. And then that allocation really is there for when the equity markets do pull back. And again, we've said on the equity side that we're likely due for a pullback.
So with that, let's transition into our discussion on cybersecurity. We've got about 15-20 minutes left, which is perfect timing. If anyone has any questions, though, on either the economic data or the market data we just discussed, again, feel free to reach out to your SilverOak advisor or give me a call. I'm at 952-896-5701. For cybersecurity, we'll start out with why is it important? Well, it's pretty obvious, right? Data breaches are becoming more common. Fraud's becoming more prevalent. We obviously don't want to disclose all of our private financial information that can be relatively sensitive to these unknown folks that who knows what they end up doing with the data. It can tarnish your reputation, tarnish your finances, it can be costly, time-consuming, etc. And I guess one comment I would make here is don't think it can't happen to you. This can happen to anyone. Even some of the smartest people I know have inadvertently become victims of some type of identity theft scam. And I'm going to give you an example in a few minutes that will probably knock your socks off because you just can't believe that these things happen, but they do. So what are the best ways to prevent identity theft. Well, Jonathan, you know, we're always talking to our clients about getting copies of their credit reports. And many times, I don't know if you experience this, but many times it'll be, well, yeah, you know, I'll get it, but it's kind of a sense of no urgency, not really that important. I'm not going out and getting a mortgage, so what do I care? But really having that credit report creates a baseline for then moving forward, so that if something happened in 6 months, and now we're trying to figure out exactly what happened and building the pieces, we can look back to your credit report from the 6 months prior to say, hey, it looked good then, so that's our baseline. Now let's look at what's changed. So it's great for that purpose. Also, another way to prevent identity theft is to sign up for credit monitoring services. With the Equifax breach, they're offering 1 year of free service. But even if you weren't impacted by the Equifax breach, you can still sign up for credit monitoring. And certainly, freezing your credit is an option. So if you don't want to worry about monitoring, you just want to freeze your credit altogether, Jonathan's added here the 3 links that you would use for each of the 3 credit reporting agencies. The first one's Equifax, the second one there in the middle is Experian, and then toward the bottom is the freeze for TransUnion. So you can freeze your credit at all 3. Any points that you'd want to make on the process of freezing the credit, Jonathan?
Well, the freezing sounds fairly complicated, but it's really not. It's actually fairly easy, doesn't take much time. You'll want to make sure you do it for yourself. Your spouse does it as well. And also, you want to make sure that you keep the PIN. And
good point.
Put that in a safe space, and because you might have a time where you want to unfreeze it, and you'll need that PIN to be able to do that.
So each of the 3 issue a separate PIN number, and you have to have that PIN to unfreeze your credit. And you may eventually need to unfreeze your credit, as Jonathan just alluded to. So we've suggested for our clients, call us with your PIN numbers. We'll put them in your permanent file so that if you misplace that PIN number in 2 or 3 years and you go to unfreeze it, we'll have it on file for you to utilize. Otherwise, I suspect it's like moving a mountain to get your credit unfrozen. Another thing, Jonathan, that you added here was pre-approved credit cards.
Yep.
To opt out of those.
Yeah, and on top of that, we provided a link to the Do Not Call list, so you'll want to make sure your cell phone, your phones are on that list, and then a link to the Direct Marketing Association so you can get out of other sort of online junk mail.
Yeah, good points.
Now, really, when you look at it, there are things that you can do to protect yourself. And so kind of the big bullet point here is you do need to safeguard your information. So you have to think about all the financial documents that you have. You need to make sure you shred them. I didn't go into the level of detail, but you want to make sure you have a shredder that just doesn't do it on a strip basis,
Yes.
because that can be easily put back together through software. Never give out your personal information unless you initiated the contact. So meaning if somebody from bank XYZ calls you, you don't do business with them, you do not want to give them your personal information.
And on that note, a lot of these best practices focus on computers and the internet and all of that. But these folks are going old school again. And they're doing a lot of phone scams. As a matter of fact, in the last 2 weeks, I've gotten 2 voicemails from the IRS saying that if I don't call this number back, they're going to issue a warrant for my arrest. Of course, these are scams. Everybody can rest assured I filed my taxes, everything's good. They're not after me. But if you didn't know that the IRS doesn't make phone calls, you would think that this was legitimate. And you would probably call the number and maybe give them some personal information. So remember, the IRS never calls you. But the reason I mention this is there was a CNBC article just in the last couple of weeks about Richard Branson. Everybody probably knows him. He's a billionaire. He's really involved in the British Virgin Islands. And after Irma came through, he spent a month there in the British Virgin Islands trying to help with the recovery efforts. During this time, one of his best friends, a business associate, another billionaire in the U.S., got a phone call supposedly from Richard Branson saying that they needed $2 million wired down. He was doing this work in the Virgin Islands. He couldn't get access to his UK bank accounts, etc., etc. Supposedly this individual impersonated him to a T, knew personal information about him, had the same dialect and everything. And the guy fell for it and wired $2 million and didn't even know it was a scam until he sent Richard Branson a few weeks later an email asking when he was going to get paid back. And of course, at that point, Richard Branson said, "I don't know what you're talking about." So even very sophisticated multi-million or billionaires can be victims of these scams. And they're not all internet related. They're going old school as well. So be very careful.
So the next kind of couple really look at your software. You want to keep it up to date. That's where we've seen a lot of hacking. And then also, we'll talk in a little bit more detail, but it comes down to passwords. And one of the things you also want to consider is using a vault, because one of the best practices, and I think this would be hard without a vault, is that you should really have a different password for each website.
Yes.
And so really that's the only way to do it. And what I'll tell you is there are a lot of providers out there. There are a lot of good products. It will really come down to whether you're using it on a desktop, whether you're an Apple user or an Android user. But there are a lot of reviews out there, but we'd highly encourage looking at that. But again, it's email and login information that's really the most important. So first of all, don't open spam. If you get kind of a weird email with an attachment, don't open the attachment. If there's a link, don't click on the link. And quite frankly, if you're getting email from people you don't recognize or organizations, you don't want to open those emails. The next thing is really this idea that your email information really should be more private, because that's really how hackers start out, is they start out with your email. And so one of the things that's now considered a best practice going forward is really using a separate email for your financial accounts that only you know about. It's not what you email friends or other colleagues from. It's just for your financial accounts. And you don't want to use any identifying information, your name, age, anything that can be found online. People can guess at these things and generally gain access.
Well, when I've been hearing you and I talked about it, not answering those security questions that a lot of sites have, honestly. So like when it says, what's your pet's name? Don't put in your pet's name. Make up one, because it's not that hard to probably go out to your Facebook or some other social media and find out, well, what's Jonathan's pet's name? If I really wanted to, I could probably figure that out pretty quickly. So answering it with a different name than the obvious that would be posted.
Yeah. And another couple things, when looking, when you first kind of establish an account or an online account, make sure you use the most secure password reset option, because that's a way that hackers start the process. Whenever possible, utilize a two-step verification process to log on. And then when you look at your passwords, you need to make them much more complex. So they should at least be 12 to 15 characters, one lowercase, one uppercase, one number, and one symbol. And again, don't use information that can be found online. And also consider using what's called a mnemonic password. And that's where you start with a phrase that might be meaningful to you, and then you use the first letter of each word, and then you swap out some of those letters with numbers and characters, because that's something you'll remember, but it's really unhackable when you do it that way.
Yeah, and I mean, it really just comes down to the basics, right? I think most experts that I've seen say the best prevention comes from common sense daily practices that aren't complex and they're not very expensive. It just, as Jonathan said, don't click on those spam emails and the links that you don't know where they're to. And of course, a lot of this is getting into more of the technical components of using Wi-Fi and other wireless services. Again, pretty basic stuff, but be aware of this, right? Know the Wi-Fi that you're tapping into, and if you're at Starbucks, that's probably not the most secure Wi-Fi to be tapping into.
Absolutely. And there was a Wi-Fi hack in the last couple of weeks. Microsoft and the other big software providers are providing patches, so when they're available, you want to update your software.
Good point. Good point. So how do you tell if you become a victim? Well, most people will know, right? You'll be notified that there was a breach at a company that you do business with and that your information may have been compromised. You'll see withdrawals or purchases that you're not familiar with. And this is why we highly recommend to our clients to get their credit reports, monitor them, look at your bank statements, look at your Visa and American Express credit card statements. You just got to be familiar with your finances, and sometimes it takes a little bit of time to go through those types of items, but it really does make a difference. What if you're a victim? Well, obviously, you need to contact the 3 credit reporting agencies. And we've got the phone numbers here: Equifax, Experian, and TransUnion. You should contact the Attorney General's office for the state that you live in, and also report the incident to the Federal Trade Commission, the FTC. And many times you'll also want to do a police report as part of that process. If you're unfortunately a victim, create a file, an identity theft file for your records. Keep everything. Keep copies of all of these things that you're submitting and all the information that you're gathering. Also, review your homeowner's insurance policy to see if you have any coverage through your homeowner's policy. Probably not.
Well, yeah, most insurance companies have a rider that's available.
So you have to buy it.
You do have to buy it. It's not that expensive, $25, $30, and it helps cover your costs when you're restoring your identity. But you'll want to look at your policy. If you don't have it, contact your agent, get that added. It's not that hard, and it will provide some coverage of your costs.
And of course, if you use some companies that do the credit monitoring, they supposedly offer some level of insurance to help kind of recoup some of the cost of identity theft as well. So next steps, if you are a victim, of course, you want to go through the process of disputing any fraudulent purchases, have new credit cards issued, dispute any errors on your credit reports. Probably most important is contact the IRS. File an ID theft affidavit. It's Form 14039 with the IRS, so that they're aware that you've had your identity compromised. Otherwise, if you don't do this, it's very possible that that information that was gathered inappropriately could be used to file a tax return on your behalf early next year. So this would be, let's say, in February of 2018 for the 2017 tax year. And by the time you go to file a return, the IRS says, oh, nope, Jonathan, somebody's already filed a return. You can't file one. And of course, the earlier one that was filed was fraudulent, probably asking for a big refund. So be sure to contact the IRS. And frankly, we don't have it on here, but if you are a victim, call your advisor immediately. Call your banks, your brokerage account custodians, and of course for our clients should contact their SilverOak advisor immediately so we can make sure that the damage doesn't get any worse in any way. So with that, a few SilverOak updates. Great news. Emily, our operations manager, and someone I know probably everybody on this webinar is familiar with, she'll be returning from maternity leave in a little bit less than a month, so we're very excited for that to happen. She just brought in our baby a week or two ago, just lovely, lovely little baby. So we're happy to have her back. We're also happy to announce that we added an investment operations analyst role, and that individual is going to be starting in early November as well. And we have a new administrative assistant on hand as well. Actually, today is her first day. So a lot of good things happening there on the personnel side. On the IQ side, our investment quality scoring system, we're just completing our global asset allocation optimization project. We already alluded to the real asset project that we just completed. And John, one of our CFAs on staff, is completing a review of our passive investments because we do have a fair amount of clients in passive investments, not just actively managing investments. And of course, we have some year-end reminders. As the year-end is fast approaching, unbelievably, here are some items that you probably just want to go through and check off to make sure that you're completing. And then we have our 2018 updates for IRS contribution limits for the 401k, the HSAs, and the IRAs.
And then Social Security is going to have a 2%
cost
of living increase. So it's the biggest increase in, I don't know, 5 years.
That's great. Yeah, last year was 0.
So
2% is better than 0. With that, we're going to close out today's webinar. We appreciate everybody that attended. And as I mentioned, if you have any questions, contact your SilverOak advisor or call me directly at 952-896-5701. Thank you for your time, and have a great day.